Hi, Gigi from the RBA. This video is our second on unconventional monetary policy tools. It completes our discussion of monetary policy tools and how they affect different interest rates in the economy. In the previous video, we discussed forward guidance and asset purchases. This video will discuss the RBA's term funding facility and adjusted market operations. Remember, in the previous videos, we learned how unconventional monetary policy tools work by influencing longer-term interest rates, both directly and through expectations about future short-term interest rates, and also by reducing the uncertainty that interest rates might rise in the future. These are relevant for the policies we will discuss in this video as well. However, as we'll see, these policies also serve other important functions. So let's start with the term funding facility, or what we call the TFF. The TFF has involved the RBA offering to provide low-cost funding to banks for 3 years. The goals of the TFF are to reduce the cost of borrowing for households and businesses, and to encourage banks to lend to businesses, especially small and medium businesses. Let's talk more about how the TFF works. Well, basically, banks borrow money, called funding, from the RBA. We call the money funding because it's used to fund the activities of the bank. Now, the RBA just doesn't give this funding to banks. The funding is secured, meaning that banks have to pledge assets of at least equal value to access the money, which are held by the RBA until the funding is paid back. Think of this like when someone borrows to buy a house. They have to pledge their house as security to access the loan, and they're only released from this pledge once the loan's repaid. In return for the funding, the bank pays an interest rate to the RBA, which is fixed over the 3 years the funding is provided for. At the time of publishing, this interest rate was 0.1%, the same as the target for the cash rate. Now, to understand why TFF funding is important, we need to know two things: what other types of funding banks have, and what activities they use this funding for. The largest source of banks' funding is deposits from customers, like you and me. The cost of this type of funding is the interest rate that banks pay to its customers on the deposits, like the interest rate you receive on your savings account. Banks can acquire funding from other sources as well. For example, they can borrow money in financial markets by creating bonds for investors to buy. The cost of this funding is the yield on the bonds when the bank first creates or issues them. These funding sources differ in how much they cost and how stable they are for the bank. For example, household deposits are a stable source of funding. Stable means that the bank is confident both about the amount of funding it can obtain and that the cost of keeping that funding won't change by too much or too quickly in a short period of time. Funding that is borrowed in financial markets can be less stable because its availability and costs can fluctuate as conditions in financial markets change. Now, the TFF is important because it provides a source of very stable funding to banks at a low cost. This also helps to reduce how much banks expect their funding to cost over the term of the TFF and increases their confidence in this expectation. So why does this matter? Now, the answer lies in our second point: what the banks use the funding for. Banks' most important contribution to the economy is to use funding to make loans to customers, businesses, and households. Banks can use their TFF funding to make loans. In return, banks will receive interest payments, measured as an interest rate on the loan. The cheap, stable funding from the TFF enables banks to reduce the price of loans for their customers. In other words, they can reduce the interest rates they charge businesses and households for borrowing. The TFF then has a similar goal to a reduction in the cash rate target, forward guidance, and asset purchases to reduce interest rates in the economy. The difference with this tool is that it focuses on banks rather than on reference interest rates such as the cash rate target or the risk-free yield curve. The TFF also has another aim: supporting the supply of credit to businesses, especially small and medium businesses. In times of high uncertainty, such as during the COVID-19 pandemic, banks may become hesitant to lend money to riskier customers, particularly small and medium businesses. They may feel unsure about whether borrowers can pay the money back. They will be especially worried if the funding they use to make the loan is expensive or not very stable, which is more likely in a time of high uncertainty. In response, the bank could charge a higher interest rate than they normally would, or could even just refuse to lend the money. But uncertain times are often when businesses need a loan the most and are least able to afford to pay a higher interest rate. By providing secure, low-cost funding for a long period of time, the TFF can help ease banks' concerns about their funding and support them to extend loans to businesses. This keeps the supply of credit flowing to the economy. So finally, we'll talk about our last unconventional tool, adjustments to the RBA's existing market operations. Market operations can help financial markets keep functioning smoothly, especially during times of extreme uncertainty and distress. One recent example is the initial spread of the COVID-19 pandemic in March 2020. Before we talk about market operations as an unconventional tool, we need to know a little more about how financial markets work. In financial markets, there are buyers of financial assets, like bonds, who provide money, and sellers of financial assets, who receive money in return for the asset. Between these two groups, though, there is usually a financial institution, like a commercial bank. The bank buys financial assets from sellers and sells them to buyers to make the market work. Financial markets are set up like this because individual buyers and sellers of assets can often find it quite difficult to transact with each other directly. In times of extreme uncertainty, participants in financial markets can become very worried about what the future may hold. Many holders of assets may want, or in fact need, to sell their assets in the secondary market to obtain cash, the safest asset of all. But there may be limited buyers for those assets because those with cash are inclined to hold on to it rather than buy assets. All of this makes it very difficult and risky for banks to connect buyers and sellers of assets. In some cases, they may be unwilling or unable to do so, and some financial markets may cease to work or function properly. Think of this like a big increase in the supply of assets in the secondary market at the same time that there's a big fall in demand. So if there are many sellers wanting to sell assets at the same time, but very few buyers for them, then the prices of those assets can fall very sharply and become very volatile. That is, they can move around a lot. These sharp movements add to the uncertainty and can lead to more sellers entering the market, resulting in further price falls. So from our bonds and yield curve video, we know what happens when the prices of assets such as bonds fall. Their yields increase. When prices fall very sharply, then yields will rise very sharply. So two problems can arise in this situation. First is that interest rates and yields on some assets may stop reflecting their underlying value. For example, if the yield curve stops being a reliable indicator of risk-free interest rates, it's no longer a good reference point for other interest rates in the economy. This can reduce the RBA's ability to use its monetary policy tools to influence broader interest rates in the economy. The second is it can become extremely expensive or even impossible for financial institutions and businesses, or even governments, to borrow money by creating assets in the primary market. Lenders of money in the primary market will find it very difficult to assess the risk of lending and will prefer to hold on to their cash, especially if they are unsure about whether they can later sell the assets they are buying in the secondary market. This comes at a time when financial institutions and businesses most need to borrow. So what can the RBA do in this situation? One thing it can do is to help reduce the uncertainty for investors by ensuring there's enough access to cash in financial markets. The RBA does this by lending money for a short period of time to banks and other financial institutions to help them keep playing their important role as facilitators of transactions in financial markets. Much like the TFF, these loans involve financial institutions pledging high-quality assets in return. One type of loan the RBA uses is called a repurchase agreement, or repo, and it's used all the time by the RBA as a part of its open market operations when it is implementing the cash rate target. What's unconventional about this tool is the scale and speed with which the RBA can make these loans in times of market dysfunction. With the money loaned from the RBA, financial institutions are better able to meet the demands of sellers wanting to convert their financial assets to cash, and gives the creators of assets in the primary market confidence to keep creating them to borrow money. This reduces the uncertainty participants in financial markets face about whether they will be able to transact at a reasonable price, making them and other short-term lenders of money more comfortable with transacting in markets and helping to reduce the interest rates at which they do so. In March 2020, the RBA increased its short-term lending to financial institutions in this manner. Another thing the RBA can do is enter dysfunctional markets as a buyer of assets to restore their normal functioning, or at least signal that it's prepared to do this if it becomes necessary. This gives buyers in the market more confidence to transact because the RBA is standing behind the market, so to speak. If more buyers enter the market, including if the RBA enters the market to buy assets itself, this can help correct the imbalance between buyers and sellers. Prices of assets and their yields should return to more normal levels and the market will begin to function smoothly again. In March 2020, the RBA purchased government bonds to help restore normal functioning to that important financial market. However, these purchases are not really the same thing as the asset purchases we discussed in the previous video. Rather than persistently lowering the yield curve, instead, these purchases were targeted at dealing with market functioning problems. So that's all for this video and our series on monetary policy tools. Next up, we're going to look at monetary policy transmission. See you next time.